Okay, we're continuing this series, Price Action 101. And this is again the analysis of price action. Not exactly the same as technical analysis. Absolutely, there's going to be some overlap. But I think when some people talk about technical analysis, they're talking about something else that isn't as rigorous and scientific or mathematic as this, or mathematical, I should say. So, do want to make sure that we're making that distinction here very important. And so, we left off by saying price action analysis is a game of probabilities. So you're trying to you're looking for situations where the probability is in your favor, which is to say you have better than a 50-50 chance. In most cases, your edge, which is to say the the chance that you're right is going to be, not much more than 50%. I mean, a 60% edge is actually huge. So, I mean, when you think about edge, when I talk about, edge, I'm not talking about like an 80, 90, 95%. That's crazy. There's no such thing as 90% confidence in the markets. Someone tells you that, they're wrong. You can get lucky and be right, but there's no way there's some kind of analysis that leads you to 90% confidence of something. That is bullshit. So probabilities, and I would just go further and to say, almost all of life is about probabilities, whether we realize it or not. There's almost nothing where there's a 100% chance of something happening. Maybe there's like a 98% chance of it happening, and so effectively it seems like 100%, but I don't know. I don't think that that's actually the reality. And so if we understand that it's about probabilities, we have to understand the conditions of price action. So like what what are the things that price generally does? And the reality is price only does three things. It either moves in an uptrend, which is this example here, or it moves in a downtrend, which we'll review, or it's moving in some kind of range. Those are the only three conditions. Those are the only three conditions. It doesn't matter what market you're talking about, whether it's crypto, commodities, stocks, anything that trades with an open, high, low, close. Remember what we talked about in the previous video, open, high, low, close. As long as you have those three variables, you are going to have either a market that's trending higher, trending lower, or in some kind of range. And sometimes that range will sort of oscillate, right? It'll sometimes be trending, within the range, you'll be heading higher, and sometimes within the range, you'll be heading lower. But make no mistake about it, you're in a range. So we'll start with the uptrend example, which is the most common one. This is the one that the stock market is often in. Broader stock market right now, we're going through a huge meltdown, which I'll talk about in these videos as well. This is a perfect time to start investing, especially if you're on the sidelines watching, the NASDAQ is down, like I think something like 25%, S&P is down like 15, 16, closing in on down 20%. There are individual stocks that are down 90%. Crypto is blowing up. We're going to review some of this stuff live. But this is the perfect time to start observing what price is doing. You don't have to put any money at risk. Observe what price is doing. See if you can spot those scenarios where the risk reward is tilted in your favor, where the probability of a certain outcome is higher, right? And so see if it does move in that way, right? Just track that over time, gain your confidence. And so to stick to the uptrend example, this is an example of an uptrend. I'll go back. This is a, kind of sort of idealized version of an uptrend. On a real live chart, it'll be much less clean than this, but the idea is to show you the cleanest version. And then when we get to the live charts, you can sort of start to see how you can kind of, plot this pattern against the real chart. Again, it's not going to look perfect, and that's kind of the point. Nothing in real life looks the way it does in a textbook. It's about spotting the general pattern. And so here's the important thing, right? This is our starting point, right? And imagine, prices along here, right? So like, like $1, $2, $3, $4, what have you. We'll go through a real chart. You'll see real examples. Again, this is an idealized version. So uptrend moves in higher highs and higher lows. I'll say that again, and you'll play this video back. Think about this. Go into your own charting software. I would recommend TradingView. You can set up a free account. Higher highs and higher lows. It's the higher lows that I think trip people up. Higher highs make sense intuitively. If something is in an uptrend, it's making higher highs, which is to say it's going higher than it did before. What people tend to get tripped up on is the higher lows part. Now, what that means is, like, so this is a high, this is a higher high, right? Because this high is higher than a previous high, and because this chart is just starting from scratch, it'll make more sense as we go through this. So this is your high, right? And then notice, so price went from here to here, and again, remember there's price along this axis. So price went from here to here, and then it pulled, and then it dropped, right? It fell, it went down, it went from here to here, right? But then it stopped going down, and then it went up again, right? So this is your higher high. This is your higher low. This is another higher high, and now this might make a little bit more sense because you can compare them more readily. Think about it. This is another move of price going higher, right? Right? Like, so price, the first time price went higher, went from here to here. Now it's gone from here to here. This is another high point. Is this high higher than this high? Yes. Therefore, it is a higher high. That's what that means. It's a high that is higher than the previous highs. And then we had price go down for a little bit. So what is this? It's a higher low. Why? Because it's a low that is higher than this low. That's what that means, right? So price makes a higher high, higher than this one. But after a higher high, you expect a higher low. And again, this is what gets people tripped up, right? Because people buy like right here. They see price going up and they're like, oh my God, I don't want to miss it. I got to get in. And then it does this, it stops going up, and then it starts going down. And then they panic, right? They're like, oh my God, it's going down. And they sell like right here, right before it makes a bottom, and then makes a higher low, and then another higher high. And so you need to be aware of this. You need to be aware of this, right? When you're in an uptrend, there's going to be a point where price is going to pull back. It's called a pullback. This is called a rally. This is called a pullback. Rally, pullback, rally, pullback. There are other words for it. This is also called an impulse. This is called a retracement. We'll actually stick with that, right? We'll call this the impulse. We'll call this the retracement. So the impulse moves in the direction of the trend. So if you almost even look at this, like if we just even kind of ignore these individual, like you see these are like stairs, right? If we almost even ignore the individuals, we start here and then we end up here. So we're clearly going higher, but along the way, we're gonna make these higher lows, which again is super important. So when the market is in an uptrend, when something is in an uptrend, you don't wanna just try to jump in right here, right? You wanna try to jump in somewhere around here, a low risk point, or right here, really, after you confirm the bottom. After you've confirmed that this is a higher low, you're like, oh, we came down here, we stopped going down. It's like, oh, this is a low we made because we're moving up again. Like, how do I know it's a low? Well, because we're moving up. And then I can compare this low to that one. So we keep going with this, right? This is another high. This high is higher than that, which is higher than that. And then you have your low. This low higher than this low, higher than this low. Then you have another higher high, another higher low, a much higher high, right? And this is important to understand as well, the magnitude, right? The distance between this high and this high and this high and this high is a lot less than the distance between this high, and this high. So we had a pretty very, very rapid advance. And that's something that you want to pay attention to, because sometimes a very rapid advance is a sign of exhaustion, right? That like, if we've started going at a too fast a pace, we may start to consolidate a little bit. And that's what's happening in this chart here. We won't go through this section because this is actually a downtrend. I don't want to confuse anyone, but notice this is a high, this is a low, right? This is a higher low because this low is higher than this one. This is a high, right? So we had a low and then we move up. Is this high higher than the previous one? No, right? It is higher than this high, but it's not higher than the previous high. What matters is the high directly before the existing one, right? And so this high is lower than this high. So that's a warning sign, right? You don't want to see that. And then we make a low. Is this low higher than this low? No, it's lower. So that's also a warning sign, right? And then we have this high, which is lower than this high lower than these highs. So you can notice this high, this, or I should say this high is lower than this one, and then this one is lower than this one, and then this one is lower than that one. In the next slide, we'll cover a downtrend, but that's what it looks like, right? So this is an uptrend that kind of sort of started a shallow downtrend. And then we make this low, which is lower than all of these. That's a big warning sign that we're about to clean house. And in fact, this low is even lower than this one, which is a really big warning sign. Like you basically, if once you make this move down, you've lost all of these gains, right? All of these gains have been wiped away. But then you start another uptrend again. This high is higher than that one. This low is higher than this one. This high is higher than that one. So, right, so higher high, higher low, higher high, higher low, higher high, higher low, higher high, and it keeps going. So that's an uptrend. Again, anytime a stock starts going anytime an asset starts going parabolic, looks like it's going to get away from you, calm down, relax. It's going to pull back at some point. Every impulse has a retracement, always, always. And it makes sense when you think about it, going back to, who's actually moving price, right? At some point, right, like they've got to let up on the selling, or buying, right? And that's when you start to get that retracement, right? When that large buyer is taking a break, right? They're not selling anymore, so the selling pressure lifts a little bit, or they're not buying. And the specific reason it happens is less important than the general concept is it has to happen at some point, because money, like capital, is not infinite, right? For this to just go up with no retracements would mean like infinite capital, right? Like market participants just have unlimited amounts of capital to keep plowing in, keep buying, and that's obviously not the case. The downtrend example is exactly the opposite, right? So instead of higher highs and higher lows, right? So instead of the higher highs, you're making lower lows. And instead of the higher lows, you're making lower highs. And I think the lower high confuses people in the same way that the higher low confuses people. And again, I encourage you to watch this, play this back several times. It takes a while to really kind of sink in. So in the same way that we started from left to right, we'll start from left to right here. So we made a move down. So this is your low. And we made a move up. So this is your low and this is your high. This high is a lower high because it's lower than up here, right? And then we make another lower low. This low lower than this one. And then we make a lower high because this high is lower than this one. And you can see it's just the pattern continues. Lower low, lower high, lower low, lower high, much lower low, right? Much lower than, we had a big leg down. And then we almost get back to this high here, but it's still a lower high. You can see this is lower than that one. And then we start, remember in that last example, we had a shallow little downtrend, it's a shallow little downtrend in the middle. In this case, this is literally just the mirror opposite. So we have a mini uptrend, right? So we have this high, which is higher than this one. We have this low, which is higher than this one. Another higher high, another higher low, just marginally. Another higher high, then the downtrend starts again because we have another lower low that takes out all of this. And then we continue. Lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So in the same way that the final destination for the uptrend was higher, the final destination for the downtrend is, the opposite, lower. You start here and you end up here. Again, remembering there's a price chart here. And so what people will do in a downtrend is they'll get really scared and they'll sell like here, right? Or I should say they'll sell like here, right? Or something like that, right? It's like, but wait, we're probably going to get a little rally and you want to get out around here. And we'll go in much more detail, but this is a swing high and you want to get out once the swing high has been confirmed. And so this is your way. And if you're really aggressive and you want to short, this is where you would short right after the swing high is confirmed. and your target would be below here because you would expect that it's going to make a lower low and probably overshoot. And so in the same way that price can't go up, without having, that pullback, price can't go down without having a pullback. And in this case, a pullback, not to confuse you, is actually higher, right? That's why I prefer the term impulse and retracement, because impulse just means it's moving in the direction of the trend. So this is an impulse leg, right? Because it's down. This is an impulse leg, impulse leg, impulse leg. These are the retracements. So the retracements are the higher lows. So in a downtrend, if you want to sell something, you want to wait for the lower highs because that's going to give you a better selling point. That's what the big institutions do. If you are, you've got 1 billion shares worth and you've got to unload them, you're not selling them down here. You're waiting for price to make a move up, and then you start to unload as price gets higher. And that's why the selling starts again, right? Like that's where, you get up here and then the selling starts again, you make another leg down, etc. And then you have the most frustrating action of all, and that's what sometimes is called sideways. It's also called range bound, where you're just moving in a range. Like remember that first example went from up here to up here. The previous example went from up here to down here. In this case, we're going from here to basically here, right? Again, price is here. So we essentially spent this whole period going nowhere. And the way you're in a range, this is really important. People say, like they use indicators to tell them if they're in a range. You don't need that. It's literally just math. Are you making higher highs and higher lows? Then you're in an uptrend. Are you making lower lows and lower highs? Then you're in a downtrend. If you're not doing either of those two things, you are in a sideways market. It's that simple. If it's not a downtrend and it's not an uptrend, it's a sideways market. There's no other category, right? And like let's investigate this, right? So let's start here. So we made a low, right? But this low is higher than this low. So okay, are we in an uptrend? Well, we made a high. This high isn't really higher than this one. I mean, it's marginally higher. Then we made a lower low. Oh, so maybe we're in a downtrend. Nope. This is a high that's not lower. It's not a lower high, right? And then we made a lower low. Oh, lower high. Uh-oh, we're in a downtrend. Another lower low. Now we made a lower high. So you get this kind of frustrating where you make a lower low, but then you don't make a lower high. You make a higher high, but then you don't make a higher low. You make a lower low or a lower high. The point is it's confusing. It's a way to lose money and just get chopped up. And we'll talk about this. Sometimes markets enter into these conditions for months and even years. And these conditions should be avoided like the plague. And once you understand how to analyze price action, you'll know when this is the condition that you're in so that you can avoid